to the Bean Ninjas podcast, where you get an all-access pass to see what happens behind the closed doors of a fast-growing global bookkeeping and financial reporting business.
Hey everyone, and welcome to another episode of the Bean Ninjas podcast. Today we have Mario on the show, and Mario is also known as the Tax Guy. And on today's episode, we're going to be talking about all things US taxes. Welcome to the show, Mario.
Hello. An exciting day, US taxes.
maybe more exciting for us as accountants. But
I know. To be honest, it's funny though. You know, you could be almost anywhere though, because taxes hit everybody. Where for some reason everybody wants to talk to you at the cocktail party because they think you have the secret sauce to fixing everyone's tax problem. So it is kind of interesting.
Absolutely. So let's start with a little bit about you, who you are, and your background, which has taken you to where you are now.
Sure. So obviously, I'm a US-based CPA. I have a small firm in Connecticut called Greenhaus Riordan Co. We have 10 people, so me and one other partner, and then 8 other staff, most of which are CPAs. And, we help clients all around the world with pretty much their U.S. tax problems. So whether it be structuring new business, buying an existing business, selling a business, or even just tricky individual tax questions. So yeah, that's pretty much it. Been at it for a while now, probably about 10 years, and that's about it.
Before we get into the taxes side of things, I know a lot of the listeners of this show are business owners themselves or wanting to become business owners. And I always find it interesting to hear a little bit of the backstory. So how did you become a partner in this firm?
Well, so I started actually at one of the big 4 firms, which, there's really no end in sight there. Just wasn't really feeling like I was helping anybody. I've always been somewhat entrepreneurial since I was, in high school. I was around when the CD burners used to come out. I would burn CDs and sell them in high school, and I would buy shirts on eBay in bulk and resell them on eBay. So I was always doing something. And when this opportunity came up, I said to the person, the partner at the time, I said, well, eventually I'd like to become partner. And he said, well, you'd have to really build your own business within this business, and you have the opportunity to do that. And I said, all right, well, then sign me up. So that's when I left the big firm to go to this firm. And pretty much I did exactly that. I made partner at, I don't remember, I think it was age 27, which was the youngest in firm history. So that was a good accomplishment.
Yeah, absolutely. I remember back in my accounting days, I worked at a firm called BDO. It wasn't Big 4, but it was a large.
There you go.
Yeah. And that path to partnership, it was a long road, and 27, that's a great achievement.
Yeah, it was interesting, but yeah, it's been great though. It's nice because, you choose your destiny. I can take on more clients if I'd like. I can fire some clients if I'd like, or I could hire more staff. I could grow, or I could fire some staff and say, well, you know what, this is enough income for me. I'll keep these clients and get rid of the rest. It's just nice to control what you would like to do and work with who you want to work with.
Gives you more options to follow the path that you want. All right.
Absolutely.
We'll get into the first topic that we're going to be discussing today is sales tax. And there's been some recent changes in sales tax, which I know have created some uncertainty and a lot of questions. Before we jump into the changes, could you just describe to our listeners, especially those that might not be overly familiar with sales tax, a little bit about what it is, who it applies to, and the basics of what they need to know?
So sales tax, right? So I guess very basically, if you walk into any store and if you buy any tangible personal property, so whether that be a mug or a lamp, usually there's a sales tax charge for that, and then the state, the business is required to collect that tax and then remit it over to the state every either month or quarter or year, depending on, usually quantity of sales. So, the first requirement that you would have to be subject to, or I guess to be required to charge sales tax, is this concept of nexus. So you have to have a connection to a specific state to be required to charge sales tax. So, what is this connection, that I speak of? So the connection can be a physical presence. Not very long ago, you used to have some sort of physical presence in a state for them to require you to charge your customers sales tax. So that could be through an employee, through ownership of property, having an office. Those are usually the things that would give you a nexus in a state. So, for a lot of our online sellers, this was a great thing. You didn't have to deal with much sales tax because you would only have to deal with sales tax in the state where, you and your team were located. And many times your team would be subcontractors, and those wouldn't even count. So it would really just be where your home state was, you would have to handle sales tax. Now that's kind of flipped around, I guess, let's say. Now, being an online seller is almost worse for sales tax purposes because just very recently, there was a Supreme Court decision in the United States. You could Google around the Wayfair case, Wayfair decision, Wayfair sales tax. So what ended up happening was, it was either North Dakota or South Dakota said, well, you have X number of sales in our state. Now, in their case, it was $200,000 or 100 transactions. Or it could be vice versa. It's either $100,000 and 200 transactions. But either way, they had a minimum threshold of sales, but they had zero physical presence in that state. The Supreme Court said, well, guess what? By having just a number of sales in this state, you now have nexus and are required to charge sales tax. So now every state is following suit. Not every state has done it yet, but I'm sure they will. So all states are pretty much just giving a minimum threshold of saying, well, if you have X number of sales or X dollar of sales, you now have to charge sales tax. So what does that mean? You say, well, what's the big deal, right? The company, the seller, doesn't have to pay the tax. You just need to charge your customer. So in the end, you're actually paying no extra tax at all. The real problem is just compliance. Having to file reports in potentially 50 states and different rates in different localities in each state just turns into a complete headache. It's really, that's what the problem is. The problem is not charging the tax, or, it doesn't really cost anybody any money. Customers usually can care less about paying an extra 6% sales tax. It's just the matter of, well, now I've got to collect all this money and then somehow give it out to all these states and collect the correct amount. And that's really where the issue is.
And do you have any tips for particularly these online sellers who are selling in multiple different states around how they can manage that compliance side?
So step one is really just starting to track your sales by state and being aware of these thresholds. So if you're starting to hit $200,000 in sales in a specific state, it's time to start looking at what you should do for sales tax. So there are services out there. One is called TaxJar. Another is called AvaTax. Those are really the only two games in town right now. And, in the end, they have different levels of service. Some of them, they will handle everything, supposedly. Others, you can use their software, which is supposed to integrate into your system and make it easier for you to handle on your own. In reality, it's just a burden that has to be handled. Now, others just take a risk approach. They say, well, I may be just barely over the threshold in these 3 states, but I'm definitely over the threshold in California, which happens to be an extremely aggressive state. So, well, I'll comply with California, and they make their own business decision, to pass, at least for now, on other states. But like I said, step 1 is just having a way to track your sales by state, assessing your risk, because like I was saying, it's not your tax to pay, it's just your tax to charge. So, the downfall being, if you were supposed to charge it, and if you go on 10 years not charging it, well, they're still going to ask you for it if it were to, come up by any particular state.
Yes, that would not be a good position to be in if you had to be charging it for 10 years.
Exactly. And that's the other problem is, again, if you haven't filed anything, the statute of limitations never begins, and they could go back basically as far as they want. So again, another good rule of thumb is always maintain your data, because how these sales tax audits work is, a state would audit you and they'd say, okay, I see that you have $10 million of sales. We're going to assume they were all to my state, unless you can prove otherwise.
Right.
So always maintain your sales by state. So then you can say, well, I see I have 10 million in sales, but really only 200,000 were to your state. And, the rest were amongst all these other 50 states. So, if you can't prove that data, you're sitting in a hot seat.
In the next part of the podcast, we're going to be talking about some different case studies. Before we move into that, are there any final tips you wanted to mention about sales tax, or any common questions that your clients ask you about sales tax?
I think we covered it pretty good. It's just, it's really just stay on top of the thresholds that are ever changing right now. And, see when you start hitting the certain thresholds, and then in the end, it's just comply or, pray that the government does something about it.
Yes. Excellent.
I've been doing that.
All righty. Well, we'll move into the first case study. And these are not based on being in as clients or any particular clients. I've just thought about the types of clients that we work with, and then the idea is to lead into common tax questions that may come up.
Sure.
So the first one is it's an entrepreneur. They're based out of San Francisco. They're selling on Amazon. At the moment, they're not selling on their own platform, but they intend to in the future. And really, they're just getting started. So they've opened some bank accounts and really they've found their product to sell. They've just got started on Amazon, and that's about it. Where would you start with them, and what would your advice be to them? So
in the end, just starting, in my personal opinion, is simpler is always better, right? So what I would probably recommend to them is they start their single member LLC, or if it's 2 partners, you could make it a partnership LLC. From there, obviously is getting your accounting system up. So you'd probably call Merrill at B Ninjas, right? Little plug. No, but really though, you have to get an accounting system in place. If you're an Amazon seller, it's really just knowing your inventory. And from there, right, it's like, well, the classic question I get is, how do I save taxes? How do I save taxes? How do I save taxes? Well, in truth, when you're starting out, the best way to save taxes is it's really good bookkeeping and good processes. So what I mean by that is good processes are, okay, I have my business bank account, and I've got one business credit card or two business credit cards, however many you have, one or two, don't go crazy and have 100. All of my business expenses are on these cards or this bank account, and all my business income comes in that business bank account. I don't have 14 personal cards saying, oh yeah, at the end of the year, I'm going to remember that I paid for that with my personal card. I'm going to somehow sift through my 40 personal transactions and pick that deduction out. It just doesn't happen, because guess what? You're running a business all day, and you don't have 2 weeks to sift through 12 months of your personal bank statements and personal credit cards to find all the business transactions that you had on those cards. It just doesn't happen. So step one to saving taxes when you're starting are having those processes, because just by the fact of having them in a single statement, even if you don't use accounting software, at the end of the year, half of it is there done for you just with the statements. There's all your expenses and there's all your income. Now you just need to categorize it. And almost anybody can help you do that. And then eventually, once you start growing a little bit, you can then start utilizing these accounting softwares like Xero or QuickBooks Online that'll suck in all these transactions and, again, help you balance things, reconcile things, and, really start giving you some kind of business intelligence to what your business looks like to run reports. That's really step one for the guy that's just starting out, just has a product. In my personal opinion, you get those basics done of having that separation, and start worrying about sales first, and then a little bit down the line, then start saying, all right, now I got to get some really good accounting going on.
Yep, great. And if we continue with this case study and we just move, they're a couple of years on now, so sales have really ramped up on Amazon. They've also created their own brand on Shopify. And now, originally there was one business owner, but he's brought on a partner who's great at marketing to really help him grow the brand. Would there be any different considerations now that revenue is much higher and there's an additional business partner?
Absolutely. So, at this point, right, is you're growing, again, being Amazon business, inventory kind of being your big, how would you explain it? It's kind of your big cash flow problem is inventory. So once you hit a certain level, you really should get a good accounting system going. So well, in October or November, I better make my order so I have all of my inventory in by, whenever in December that I need it, because that's when I make most of my sales. And the only way when you make most of your sales is by looking at historical data in your accounting system. So sifting through bank statements is not enough at that point in time. You want to be able to run reports on certain times of the year to see where your sales are, also to see where your cash position is, right? Because, just because you have a lot of sales in November, December, doesn't mean you have enough cash to buy the inventory you need to make those sales, which might mean months in advance, you might have to say, all right, we got to find a credit facility. How are we going to buy all the inventory we are projecting to need? Well, we may need to start applying for loans and lines of credit. And once you hit that level, sending your Excel spreadsheet to the bank, it's just not really.
It's not a good look.
Yeah. It's just not going to work. So you need the accounting system at that point in time. And then, of course, it comes to tax savings. Everybody, nobody wants to pay taxes. Nobody wants to pay taxes. So, on the bright side, under the new Trump law, the tax rates have went way down, especially for business owners. A lot of my Amazon businesses are considering C Corps now. Even, they used to never consider these in the past, just because the rate there is 21% flat. So again, a business where a lot of your money is tied in inventory, that rate is pretty attractive. But really, what most are still sticking to is pass-through entities, mostly an S corp, that is going to qualify now for what's called QBI, or qualified business income deduction.
I'll just get you just to go back and just explain with an S corp what you mean by the pass-through.
Sure. So there's two ways your business entity will essentially be taxed. So one is the corporate form, so C corporate form, which is basically saying, okay, our entity is being taxed one time flat at 21%. Done. Now, but all that money is still sitting in the corporation. So to get that money to the interested people, so to the shareholders, there's really only two ways to get it there. One is through payroll, which would be a deduction to the company, and then it would then reduce, the tax burden of the company. But of course, now you have a tax burden at the personal level. Or the second way is you pay a dividend, which would not be a deduction to the company. So you would end up paying the 21% rate plus the dividend rate at the personal level. So, just to talk a little bit about rates, so you'd be paying 21% at corporate, plus the dividend rate is anywhere between 15 and 23.8%. So, again, generally speaking, it's a little bit different between married and single, but pretty much 0 to about 200 to 250,000 in personal income, that dividend will be 15%. From about 200 to 250 to about 600, it will be at 18.3%, and then basically 23.8% thereafter. That's kind of a mishmash of both single and individual and married rates, but you could Google rate tables and just get the idea of exactly how that works. But then, the other way you're taxed is really having a pass-through entity, is what they're called, which is pretty much, you could have either an S corporation or an LLC taxed as a partnership, where all of the income of the company, instead of being taxed at the company level, is just taxed at the personal level. So all the income passes through to the personal level, whether or not you take it out of the company, you pay the tax personally, and then you're free to draw it out of the company whenever you'd like. So there's no taxable event for you actually taking cash out, like the dividend, at the corporate structure. But you're paying all at ordinary income rates, which range from 10% to 37%. So purely on the rate differential, getting the money to the owner will almost always be cheaper with a pass-through entity. But if you're accumulating profits for a long period of time at a low 21% rate, there are times where that C Corp structure is beneficial. So the answer to every accounting question is it depends, right?
Yes, exactly.
But the vast majority will be using pass-through entity structures, even with the Amazon businesses, just because the total tax to get to the shareholder is the cheapest, which is that's the ultimate goal, right? I mean, why else are we in business here?
Yeah, exactly. And still on this same case study, would there be any implications around bringing an additional business partner on once the business has already been operating for a couple of years at this point?
Right. So, there's a bunch of ways that gets done. So, they can buy in, right? So they could buy a percentage interest in the existing company. You could grant them a profit interest in the future profits of the company. There's a multitude of ways to do that. Usually that leads to more, put it this way, there's always a way we could fit it in the tax box, right? Where nobody will have a taxable event there, unless of course the seller, is selling a portion of that business. But if you're just going to grant somebody a partnership interest, there's always a way to make that non-taxable on both sides. And, but the things you have to think about are, just like with any business partner, is, what is everybody's responsibilities? What does everybody expect out of each other? And, ultimately, if we were to separate this thing, who would get what? So, a lot of that goes through the legal process, which in those cases, in my opinion, is even more important than the tax side. We could almost always make the tax side work.
And I'll speak from my own experience here, having been through a business partnership that has ended. It was really important having that documentation and agreement up front about what it would look like if the partnership ended. And we actually have a separate podcast, that one of the early episodes that talks through my experience with Ben with that business partnership ending.
Yeah.
Let's move into the second case study. And this time it's a coach. So they're a health coach. They have a team in the Philippines. They're a digital nomad, so they're traveling around the world. They still spend part of the year in America, and they're still paying taxes there. Would there be any different tax implications or things to consider for this coach?
So if they're outside of the country long enough, on the U.S. side, they can qualify for something called the foreign earned income exclusion. So there's two ways you qualify for that. You could either be a bona fide resident of a specific country, which truly means that you actually live in, Australia, for instance. Hey, you have a long-term lease, you have a visa, you still come back to the U.S. and visit family and whatnot. But you truly live there. That's where all of your contacts are. You're not making every few months a visa run because, if not, you're there illegally. Then you would qualify for the foreign earned income exclusion as a bona fide resident. But there's also the substantial presence test, which many of my clients qualify for. So if you're out of the country for 330 of a 365-day period, then again, you would qualify for this exclusion. So what this does is it really gives you $100,000. Well, it's about $103,000 that is excluded from income, which is great. I mean, you can pretty much have, all that money, or your business can earn that money and then be excluded. Now, there's a few different things that happen though. For one, if your company has a lot of expenses, for instance, if it had inventory or, not even inventory, but just had a lot of business expenses. So if you had, say, 300,000 in gross sales and 200,000 in expenses, there's a scale back of those expenses reducing your exclusion. So what we usually recommend to those clients is an S corporation, because then they could very clearly, they could have their 200,000 in expenses, 300,000 gross, 200,000 in expenses, pay themselves $100,000 salary, and then not have to worry about those nasty scale back rules. But yeah, being outside of the U.S. as a consultant, or just being outside of the U.S. in general, and to qualify for this is a great opportunity. And, I have many clients that are married couples outside of the United States that are excluding $200,000, which is only thing better than 100 is 200, right?
You can live a pretty good life in especially somewhere like Southeast Asia, with
right,
that kind of money.
Right. Exactly. So that's really the benefit of the nomad, going country to country, and a lot really kind of plan their trips around, those 330 out of 365 days. The one thing I should also mention is it's any 365-day period. It doesn't need to be, January to December. So if you go June to June, right, as a 365-day period, you'd actually qualify in both years for $50,000 each year. So, there is opportunities there that a lot of people don't realize that are there.
And could you just quickly explain what you meant by the scale back rules around the expense side?
So scale back meaning, like I was saying, if you have a lot, I guess let me use two examples. If you're a consultant, right, and you're outside of the United States, and you literally have just $100,000 of consulting revenue, you have no expenses. That's it. All you do is hop on Skype and talk to people and charge them, and you made $100,000. Great. That's awesome that you have no expenses, and you'd qualify for the full amount of the exclusion. But if you, if you had, say, $500,000 of gross income, but you have a team of 10 people that you paid $400,000, and then which still nets to the same $100,000 in income to yourself, you may lose some of that $400,000 deduction. So it'll get scaled back by, honestly, I don't even know how much off the top of my head, but just your deductions end up reducing the amount of the foreign earned income exclusion you get. So in that case, that's why we say, well, we could just kind of, go kind of around that by forming the S corporation and paying yourself the $100,000 salary. So then you can utilize the full $100,000 exclusion amount.
Great. Okay, that makes sense.
Yeah.
All right, on to case study number 3. And this is back in the US. So this is a digital agency that is based, we'll say Tucson, which is where the B Ninja's office is in the US. So it's a digital agency. They're turning over around $1 million a year. There's two founders of the business, and they also have a team that are based in that same office. So they're US employees and some US contractors. What would your tax tips or tax considerations be for a business like that?
Okay. So almost every business, and I think I started talking about this with the Amazon business, was kind of given a gift with these pass-through entities under the new law called qualified business income. So what that is any pass-through entity qualifies for this. So whether that's a single member LLC, an LLC partnership, even if it's just a state law partnership or an S corporation, what this new law did was it said, well, if you have, let's say, $1 million in profit, you're now allowed to deduct 20% of that. So nice, that's a pretty sweet $200,000 deduction. You're only taxed on $800,000. So that was like, wow, that's great. So it really lowered the tax rate to the small business owner. But with that, there was a lot of limitations. So one of them being, once you hit a certain threshold of income, so that threshold is, as a married couple, is $315,000. It is whatever half of that is for a single person. I think what's that, 157-ish thousand. Once you hit this threshold is when all the limitations come in. So basically, if you're under 300 in profit as a married couple, don't even have to think about the limitations. So now these guys, so you're at $1 million in profit, so you have to start thinking about it. So at $1 million in profit, the first limitation is you're only allowed to deduct, again, 20% now or 50% of the wages that you pay your employees. So you say, okay, well, if you have no employees, you get no benefit, right? You would have gotten $200,000 based on the $1 million in profit, but because you have no employees, you get zero. So what do? Well, one is if you have contractors, you may want to consider hiring them as employees. And the logical next step is hire yourself and pay yourself a wage. So it turns into just a math problem, right? Where it's okay if I pay myself X, right? And then there's 50% of that, and then that'll lower my profit by this much. And then you kind of hit this magic number of how much do I need to pay myself to maximize this 20% deduction? So what we're doing right now, November, December, is really looking at where all of our clients' profitability is right now and saying, okay, do we need to pay any bonuses to maximize this deduction? So that's been huge tax savings for tons and tons and tons of our clients. Now, the next limitation, which unfortunately there's no way around it, is once you're above these thresholds, again 160 or 157 and 315, if you're what they consider a specified service business, then no matter how much you have in wages to your employees, you just don't qualify anymore. So that phases out between 315 and 415 for married, and 157 and probably around 200 and change for single. So of course the question is, what's a specified service business? So those are lawyers, accountants. Let's see, what else were specified service? Like financial advisors. Anything service related, you kind of have to review what their specifics are. Consultants, they say, and then there's a big long definition of what a consultant really is. But you'd be surprised that more businesses qualify that I thought wouldn't after regulations came out, but they're still kind of working that piece out. On the bright side, all the Amazon guys, those definitely qualify, which is great. But that has saved some of our clients, in the millions of dollars in taxes.
Wow. And actually, that's a really nice segue into tax planning. What you've talked about there is one element of tax planning. With it coming up to the end of the financial year in the US, do you have any other general tax planning tips that may help businesses not pay, and individuals not pay too much tax?
Sure. So what we do this time of year, just like you said, coming up to the end of the year, is we really do two things, right? Is number one is we've got a good picture of what the year looks like so far, right? So for one, you need to figure out, well, how much am I going to owe come April? Because, eventually you got to write that check. So that's usually step one around now, is saying, now you've at least got time from December into April to save that money and set it aside for the good old tax man. And then, like you said, the other thing we do around this time of year is saying, well, what else can we do to reduce taxes, of course? The one thing, the classic is, of course, spend. You can always spend money to reduce taxes. So that's the obvious, but that doesn't get any more money in your pocket to send your kids to college. But what we usually do around this time of year is say, well, this year is either, if it's an outlier year, is this a good year to buy the big, upgrade the computer system, right? Or to buy the new truck for the business? Or is it, well, this year is just kind of a little less actually profit than the prior year, so why don't we save that deduction for the next year? Or, hey, we have, we're very close to these thresholds for this QBI deduction I was just talking about. If you were to accelerate some expenses right now, you would fall in that sweet spot and, you'll be under that $315,000. And that's very valuable in those contexts. Same thing with like retirement plans. Is this a good year to put money in a retirement plan or not? Again, a lot right now is focusing around this 20% deduction of saying, well, right now you're at $350,000 in income. If you could set aside $35,000 and throw it into a retirement account, your marginal benefit, the taxes saved by getting into that 20% deduction range have been huge on some calculations, where it's a no-brainer to do things like that, like put things in retirement funds, even though, again, I'm not a huge advocate of qualified accounts by any means. But when the savings are around 40% to 45%, it's worth it.
Fantastic.
Also, of course, is evaluating your structure. Again, back to, everything seems to always come back to this 20% QBI deduction lately. Is around now is when we tell our clients to say, hey, the S Corp may be worth it for you next year. Usually we try not to change people mid-year, just because it turns into kind of an accounting nightmare. But, this is when we do the calculations to say, well, this is how much you'll save as an S Corp next year. Do you want to do it? Because usually there's added filing requirements and some kind of out of the box downsides that a lot of people don't consider before jumping into it.
Changing structure. But also,
correct. Yeah. So exactly. I mean, this is the perfect time of year to say, hey, do we want to consider changing our structure? Because, whenever anyone's changing structure just for tax reduction versus requirement for some other reason, I always advise January 1st. Why do, the few months of savings is not going to be worth the accounting headache, unless your company's big enough that has its own back-end accounting department. Losing out in 3 months of, tax benefits, in my opinion, is not a big deal. I'd rather just have a clean cutoff, start January 1 and go from there.
And changing structure, 1st of January is actually, while you're having those conversations, we're having the conversations at Bean Indus that it's the perfect time to change accounting software. So
exactly,
whether you have or haven't changed structure, if you're not using Xero or you're not using cloud-based accounting software, then it's the right time in November, December to start planning for that transition too. So whether it's tax structure or the accounting platform that you're using.
Payroll, everything.
Yeah, it's a great time to start planning those things ready for the beginning of the new financial year. Mario, thank you so much for coming on the show. It's been an absolute pleasure having you here, sharing your knowledge about taxes in the US. Did you have any final words that you wanted to share or final tips before we wrap up?
Gosh, nothing I could really think of, but accounting it's a lot of fun.
Depending on who you talk to.
Yeah, right.
Well, again, thank you so much for coming on the show.
All right, Meryl, you have a good one.